Good morning. Good morning. I'd like to call this meeting to order of the pension board, firefighters pension board, call to order at 10:03. Ms. Kyle, will you take roll, please?
Certainly, Chair. We have Alex Romero,
Present.
Mark Landenbeck,
Present.
Chad Bradford,
Here.
Kenneth Simon.
Present.
Chair, we have a quorum.
Thank you. Has everybody had an opportunity to approve the minutes, last meeting's minutes? Or accept a motion to accept them?
I motion to approve the minutes. I second.
Motion by Mr. Romero and second by Mr. Lenity. All in favor?
Aye.
Aye. Any opposed? Nay.
Talk about the Lenity thing.
Motion passed. I just wanted to get through those minutes. Ms. Kyle, would that be okay if we just got through the minutes right quick?
Yes.
Do we need to discuss Mr. Lenity as the fifth trustee now, or should we
There's a second.
need to do it now? Okay. We need that vacancy filled. Is that correct, Ms. Kyle?
Yes.
Okay. And so it is easier to just move trustee Lenity to that position now and then let the city appoint the fifth because Mr. Leary is no longer on the board. Is that correct?
Double check with Anna. Are you hearing us?
Hi, everybody.
Hey, Miss Anna.
Can you just repeat? I just want to be clear on who you're moving to which position.
I think our understanding is that we would like to move Mr. Lenity to that fifth position
Okay.
and then let the city appoint the other as Mr. Leary has vacated his position.
Okay, that should be fine. I don't see that being an issue.
Thank
Understood.
you.
Thank you. I'll accept a motion to move Mr. Lenity.
I second the motion.
Motion by Alex.
Second.
Second by Mr. Sugden. All in favor? Aye.
So how do we get the city to start that process?
I'll speak with Karen, the city clerks to go ahead and get it. Pretty much we have to go ahead and have a form filled out and then it has to be appointed at before the next meeting. So I'll speak with the city clerks and we'll work this out.
Sounds good. Thank you.
Thank you.
All right. Next on the agenda would be Capital City.
And they have not joined us.
They have not joined us. Have you heard, are they planning? Are they going to try and?
I have not heard from them.
Understood. How should we proceed?
We can go into Mitchell's report. I'll send an email right now and see if we can get them to join electronically.
Okay. So we'll move to number 5, BCA's report, Mitchell Brennan. Mr. Brennan, good morning.
Good morning. Good to see everyone. We can go ahead and kick it off in the market overview handout, and then I'll jump into your report for the fourth quarter. So this will highlight really what happened during the fourth quarter, as well as a little bit into January, to give you a quick update since the quarter end. So on page 2, you'll see similar chart. I probably showed this last quarter, but on the left-hand side, just to look at really what's dominated markets, and that's the Magnificent Seven. So NVIDIA, Microsoft, Apple, Amazon, Alphabet, which is Google's parent company, Meta, which is Facebook's parent company, and Tesla. Those 7 companies have really dominated markets for the past 3 years. If we look at 2022, when the market sold off on inflation spiking over 9% and the Fed drastically raising rates, we saw that these 7 names led markets lower, accounted for over 50% of the total returns to the downside of the market. Fast forward to 2023, same thing to the upside. They accounted for over 60% of the total market returns. And then to round out 2024, again, they accounted for 55% of the total returns of the market. To put that in perspective, those 7 companies on average were up about 48%. The other 493 companies in the S&P 500, our large cap index, were up on average 10%. So very big disparity, very top heavy market last year. But what we've seen to start January of this year and into February is kind of a rotation of that, where these 7 companies, with the exception of Meta, have actually sold off to start the year. And there's a few reasons behind that. The first of which, if you go to page 3, you'll see this nice chart that looks like an escalator going down. And unfortunately, that escalator is earnings surprise on a quarterly basis for the Magnificent Seven. So what we like to say is these companies have become priced to perfection. The expectations have gotten so high for them that you can see starting in mid-2023, there's been a steady decline in their inability to beat their expectations. And because they're priced so high and the valuations are so high, the closer they get to just achieving expectations instead of beating them, the more volatility we see to the downside when they're just right on expectations. So everyone's built in these huge growth expectations. And when they're only just maybe beating them or right around expectations, we see the bottom fall out and a sell-off in those names. Aside from that, the other reason we saw a lot of these companies, specifically NVIDIA, Microsoft sell-off in January, was the announcement of DeepSeek, which was a AI platform developed in China for reportedly, whether you want to trust what comes out of China or not, reportedly they were able to create this AI platform that was competitive, if not better, with what's been developed here in the US for tens of millions of dollars versus tens and hundreds of billions of dollars, which is what US companies had poured in. On top of that, the new administration had just announced that they were going to be putting $500 billion more into AI platforms to keep the US at the forefront of the artificial intelligence revolution. And so unfortunately, that shook up a lot of these names. NVIDIA sold off significantly because they're high-priced products that are utilized in data centers for AI. There was a view suddenly that maybe we don't need these high-priced things if China is able to do it with dated products at a much cheaper and more cost-efficient. So we saw a huge sell-off in January because of that. So twofold: the high prices and high expectations not being met, and then a shakeup globally in terms of who's leading in the AI arms race. And so we saw that sell-off on page 4. This is a quick update through not this past Friday, but the Friday before, and I'll give you some updated numbers. But you can see here again, just a huge shift in markets. If you go all the way to the far right, you'll see technology is actually the second worst performer from a sector standpoint to start the year. And again, a lot of those companies fall within technology and consumer discretionary. So Apple and Tesla fall in that consumer discretionary. So both of those sectors are the only 2 negative sectors through last Friday, if we're looking at market performance. From a style and market cap standpoint, large cap is still outperforming, but we're seeing large cap value do much better, similar to what we saw in the third quarter of last year versus large growth. The large cap value through Friday was up 4%, large cap growth up just 0.9%, again, being a little bit more weighed down by those Magnificent Seven. So a slight shift in markets, which is somewhat healthy. That's what we like to see. We want to see the broader 493 doing well, and not just those Magnificent Seven leading markets one way or another. The next page, page 5. And so aside from those, the other big themes of the market continue to be inflation. And so unfortunately, we did see inflation start to tick back up in the fourth quarter. It was a very interesting quarter, very broken apart by each month. So in October, the market sold off a little bit, primarily due to uncertainty going into an election. Investors traditionally hate uncertainty. And so not knowing the results of an election pending, again, tends to create volatility and some downside pressure on the markets. November, once election results came in, we actually had one of the best months on record in November with that certainty coming back in the election results. And then unfortunately, we sold off in December because we did see that trend in inflation start to tick back up. So if you recall, September, we were on a very strong trend going down. We finished at 2.4% inflation in September, much closer to the Fed's goal of 2%. And then unfortunately through December, inflation ticked back up to 2.9%. And then just a week ago, we got January's inflation data, which it crept up even higher to 3%. And it's really been across the board. Shelter was up, which accounted for about 30% of the month over month increase in inflation. Energy was up, gasoline was up, food at home, which that's probably the big one you've heard, is egg prices, or have skyrocketed with the bird flu and the amount of poultry that they've had to essentially euthanize to try and mitigate some of that bird flu. But even food away from home was up over 0.5% month over month. So again, it's kind of been broadly, there's not one specific area where we're seeing inflation. It's across the board. Inflation continues to be stickier than expected. And then on page 6, and along the lines of large political events, our role is really to try and filter out the noise that we see in markets and just tell you what we see from the data and what we see fundamentally that's, in our view, going to impact markets. And so this was just an interesting survey and chart that came out. To start the year, the University of Michigan just polled investors and say, hey, a year from now, where do you expect inflation to be? And you can see the green line right in the middle, the average. Most investors think we'll see inflation tick up a little bit and stay right around that 3%, maybe a little above, depending on certain policies. If we see tariffs implemented and to what extent, we may see inflation stick around that 3% level. But if you break it out from political bias, if you look at Democrats versus Republicans, you can see the red line for Republicans, blue for Democrats. Republicans' view is that inflation would crash all the way down to 0.1%. Which sounds great theoretically, but unfortunately that would mean that the economy stalled and is stagnant and we're not growing. So we don't want to see that. On the flip side, Democrats have the view that we'll see inflation soar back over 4%. So again, filtering out a lot of that noise and the political bias of it. Again, we think inflation certainly is stickier than expected. We're likely in that 2.5% to 3.5% range for the next 12 months. And it's going to be dependent on, again, what policies go into place. Tariffs in the short term tend to be inflationary, but so far they've been used more as a negotiation tool than actually been implemented. I did just hear last night that the Canadian and Mexican tariffs are still on the table for the start of March, so we'll see next week. Again, if that's just leverage for negotiations and they get postponed again, or if they do go into effect. But I think that's what spooked markets a little bit so far this week and Friday when we saw those big sell-offs, is that deadline is getting closer and closer to that extension that we initially had for March 1st. And so there's still not clarity as far as whether they'll be fully implemented or postponed again. And then with that, page 7, inflation dictates where the Fed's path with interest rates is going to go. And so a lot of heavy lifting took place last year with the Fed cutting rates back down to a range of 4.25% to 4.5%. They still expect 2 rate cuts this year. Unfortunately, we, prior to inflation creeping up in October, November, December, in January, we're expecting to potentially see a rate cut in March. That's certainly off the table just with the trend. So our view is that the Fed, and they've said as much, that they're going to be much more cautious and much more deliberate in terms of taking in data before they make a decision on a rate cut. We think June would probably be the next opportunity for them to cut rates. They'll continue to get in February, March, April, and May's data. And if we can see a trend where it is starting to come back down, we could potentially see 1 rate cut in June and then follow up with another rate cut in December if that trend continues. So that's the view right now if we are to get 2 rate cuts this year. Interestingly enough, if you look longer term, the Fed still expects by 2027 to get rates back down to 3%, which would be 2 cuts this year, 2 cuts in 26, and 1 or 2 more cuts in 27. The market has a very different view. They still expect 2 rate cuts this year, but they're not seeing any rate cuts past that. And again, it's going to be entirely dependent on inflation if we can finally break it back down to 2%. And then just 2 more pages quickly. Certainly we want to see interest rates lower. the average US consumer is pretty debt burdened right now. If we look at just from a balance sheet standpoint on the left-hand side, the average consumer mortgages comprise about 2/3 of the debt they're burdened with. And then on top of that, we have student loans, auto loans, and revolving credit, which adds up to over 80%. So all interest rate sensitive debt components that do burden the average consumer. From a mortgage standpoint, this is the average. So if we just take into consideration new homeowners or home purchases in the last 2 years, I would suspect that 2/3 is much higher with all-time highs in terms of home values. And then mortgage rates at 6, 7, 8% versus what we saw prior to 2022, where in most cases it was 3% or even lower. So again, we certainly want to see interest rates come down to alleviate some of that burden. And we have started to see some cracks in how strong the consumer is. If you look at the bottom right-hand chart here, this is looking at balances that are delinquent past 30 days for auto loans, credit cards, student loans, and mortgages. And with the exception of student loans, auto loans, credit cards, and mortgages, those delinquencies through the third quarter of last year have all increased significantly over the past 2 years. So as interest rates have begun to increase significantly since 2022, that burden has pushed out those delinquencies significantly for those areas. Student loans is a little bit tricky because we had that student loan moratorium, which went through September of 23, but was litigated well into last year and has allowed individuals to pause their repayments. But as of October of last year, the involuntary collection process for student loans that hadn't begun repayment started. So I would expect that orange line, while it's been flat here, I would expect for the fourth quarter and the first quarter of 25, we'll likely see that tick up as well. So again, that's something we're certainly keeping an eye on, which could put some pressure on the economy if the average consumer is having to decide which payments they can and can't make over the next few quarters. And then lastly, that's a little bit depressing, but on some better positive news, from a real estate standpoint, we did see for the fourth quarter, the first meaningful positive net absorption of office space in the US. And so all that means is space that physically became occupied minus space that physically became vacant. So 3.5 million square feet more came occupied last quarter than went vacant. And that was the first meaningful time we've seen that in the past 3 years. Your private real estate manager, American Realty, we saw their first positive quarter last quarter. They continue that with a small positive quarter this quarter. So that just tells us that we're starting to see the trend of return to office. A survey of CEOs in April showed that only less than 40% of CEOs expected in the next 3 years that return to office would be full-time for most employees. In September, they redid that survey and it was now up to 79% of CEOs expecting full-time in office over the next 3 years. So again, that huge trend in return to office is certainly allowing for more occupancy across the board. And so that's a positive trend that we may see we may have seen the bottoming of the US commercial office space and start to see some, again, consecutive positive returns for your real estate portfolio over the next couple of quarters. And then with that, I will just see if there's any questions before I jump into your report. All right, so for the report, we can flip to page 4 and I'll give you the highlights. So as I mentioned, it was a very volatile quarter. We did finish down slightly for the fourth quarter of 2024, which is your first quarter of the 2025 fiscal year. The first bullet there, you'll see the plan was down $38,000 or 0.4%, in line with your strategic model, which was down 0.3%. However, we never like to see losses, but relative to your peers, you actually ranked in the top 24th percentile. So a lot of plans that I've seen and work with, they were down closer to about 1% for the quarter. So I think the conservative approach Capital City has taken, we have about 5 to 6% in cash we're underweight US equities and a little overweight cash. That certainly helped buffer some of the downside for the quarter. So kudos there. The best performers were your Spider Bloomberg Convertibles Bond ETF. That was up 2.6%. Your S&P 500 index fund through Vanguard was up 2.4%. And then cash again was up 1.3%. Other than that, most of the assets were down slightly for the quarter. We did see interest rates tick up in the fourth quarter alongside inflation going up. And so you'll see your bonds sold off to the tune of just over 3% for the quarter. Now for the 1 year, the totality of 2024, you did earn 1.2 million or 12.5%. You did slightly trail the strategic model again, while it helped in the fourth quarter, having that overweight to cash. For the entirety of 2024, having that cash, we're a little early, which is okay. You can never really time markets, but having that little overweight in cash did drag slightly. But from a relative standpoint compared to your peers, you still outperformed 87%, ranking in the top 13th percentile. Best performing assets, again, that S&P 500 index fund. So large cap was up 25%. Your mid cap index fund was up 14%. And then Cohen and Steers, your global infrastructure fund, was up just shy of 12.5% for the quarter. If we look out longer term for the past 10 years, you've generated 5.4 million in investment gains over that period and an annualized return of 6.5%. I won't go over the manager review bullets, but I will say again, just touch on the second to last one on the bottom, American Core Realty, the second consecutive positive quarter. So again, starting to see that bottoming out of private real estate, and nice to see that recovery there. And then if we go to page 8, just quickly, this is again a snapshot of how you're currently allocated versus your targets. So those gold bars are our target allocation as outlined in your investment policy statement. And across the board, for the most part, in line with most of your targets, with the exception of underweight US equity and overweight cash. So again, that helped significantly in the fourth quarter, dragged a little bit for the year because we were a little early there. But again, when you're ranked in the top 13th percentile, I think we'll sacrifice a little bit of the upside to protect to the downside, certainly with the volatility we've seen over the past quarter. And then finally, page 11, again, this just highlights a very strong year, very strong quarter, doing very well. No recommendations as far as changes to managers. American Funds Euro Pacific Growth, your international actively managed fund there, rebounded strongly, protecting to the downside, which is traditionally what we like to see with an active manager. They may struggle slightly to the upside when everything's going up, but when it matters and a quality portfolio is needed to protect when markets are selling off, that's really where their fee comes in. Paying that additional fee for active management comes into place, and you can see they protected to the tune of down 7% versus 8.1 for the benchmark. So very happy to see that recovery. They outperformed for the year. In longer term, if you look at the past decade, again, about 0.5% outperformance compared to their benchmark over the past 10 years. So happy to see that. Lastly, page 12, your fixed income portfolio. Sawgrass, your core fixed income component there, has done fine, but we've been able to buffer some of the volatility that we traditionally don't see in bonds that has come through over the past 2 years, with rates rising significantly and then bouncing back and forth in 23 and 24. We've been able to buffer some of that downside with that high yield bond fund through Vanguard there. So you'll notice if you look at the green bar, that performance versus the Bloomberg US aggregate index fund, you'll see across the board a much stronger performance from your total fixed income portfolio than that benchmark because of that additional high yield bond fund exposure. So happy to see that as well. Other than that, again, no recommendations for any changes. We are happy with how you're currently allocated. Certainly, we're starting to see some opportunities with sell-offs in the market to put some of that cash back to work. I don't think the volatility is done quite yet. So again, I don't think we're in any rush to rebalance it, but having that cash available with this volatility will certainly be a benefit over the next couple of quarters. And then other than that, I will conclude my report and open it up to any questions or discussions.
You have any questions? I have a question. Should we be seeing Sawgrass? Do they have things that, should we be seeing them? Should they be here? Should we be talking? Sir?
Yeah, we can certainly have them come in and update the portfolio and their strategy.
Do we,
I don't think that's an issue. I'm happy to invite them to the next quarterly meeting. From a performance standpoint, their results have been middling, but it's been just a very unorthodox fixed income environment since 2022. But I think it'd be healthy to have them in just to discuss. We've gotten through them for the most part, that kind of strange market cycle since 2022. So what are the prospects going forward? How are you going to set up the portfolio to benefit over the next 2 to 3 years in a more normalized interest rate environment? So I certainly think that's a healthy opportunity to have them in and to discuss that.
understood. Any other questions?
I do have a question, and it just goes back to AI. Could you help us understand a little bit better how AI is factoring into, or how it, what, because I know you said AI is in the future and it's starting to use it more and more, but how is that affecting the portfolios, or how is it affecting any of these numbers?
Sure. Yeah,
Yeah.
no, that's a great question. I think there's a lot I could touch on with that. I think first and foremost, when we talk about those Magnificent Seven, a lot of those are really at the forefront of utilizing and developing AI. So NVIDIA, the products that they produce, semiconductors, are utilized in the data centers that help provide the computing power for artificial intelligence. That's why they've seen a tremendous growth over the past couple of years with annualized returns well into the triple digits. Companies like Microsoft are utilizing things like ChatGPT, that's their platform. And so they're really at the forefront of AI, developing that. And these are tools that eventually we believe will impact the rest of the S&P 500 who will benefit from it. So right now we've seen from a market standpoint, the growth has come from those developers of AI. Eventually, the rest of the market who is going to benefit from utilizing those tools to become more efficient, to be able to grow faster with less human power and more computing power. Those companies will benefit from that. And one great example of that is, if you remember in the third quarter, Cohen & Steers, your global infrastructure fund, was the best performer. And a lot of that was due to they have 50% of their portfolio in utilities. And there was a huge tailwind behind specifically electric utilities because of the expected demand in electric power that's needed to support these data centers. And I didn't touch on it, but our market perspective on page 1 just kind of highlights the expectation in terms of the amount of electric utilities and power that we're going to need over the next few decades to really support artificial intelligence in those data centers. So again, that's when we talk about the creators are winning right now, but everyone else who's going to benefit from it in the longer term is going to benefit in the next stage of this. So while NVIDIA and those are the winners right now, we think areas like utilities, which we're already starting to see for the quarter, I believe, or quarter to date. So since January 1, utilities are the third best performing sector, up 3%. And again, a lot of that is just trying to project out in the future. Okay, we understand these companies are developing AI, who's going to benefit from it, and what's needed to improve AI and utilize an AI. And so utilities and energy are the third and fourth best performing sectors on the back of that.
So it's around the early stages of development for AI, or is it planned to be used as another investment tool? Because I don't know, I kind of see where AI would come into a good use. But I don't know, I just don't know at what capacity AI will have, what control it would have over, investments.
Yeah, I mean, as far as like the advice and investments, that we don't use AI. We prohibit ourselves from using it, because anything you input into AI data center is now public knowledge. So any proprietary information, stuff like that, it's using that bank to answer anyone else's questions. So we currently don't use AI. So nothing will change on our end. It's really just the underlying investments, how they'll be impacted by this tailwind and the growth in the market from it. And really, I mean, I think the exciting things that investors see are the potential across the board. It's kind of endless. Different sectors can utilize it. Healthcare sector can use it. Financial sector can use it. And a lot of it is really just where it may take the brain power of several individuals. If you can utilize a software platform to do it at a quicker pace, at a cheaper cost over the long run, then that makes it more efficient, more cost effective and efficient for those companies, and allows them to grow at a faster clip than they currently are.
Okay. Thank you for answering my questions.
Absolutely.
Any other questions? Someone,
Make a motion to accept the BCA report.
a motion by Sugden and a second by Lenity. All in favor?
Aye.
Aye.
Thank you, sir.
Thank you.
Ms. Kyle, should we go back to Capital City?
Apologize for being late. Highway 100 is closed, so I had to go to 3:15 to 20. So that's one.
Well, good morning. I'm glad you're here.
So for the sake of time, do you want me to?
Yes, please.
Yes, Bill. Well, is this on? Okay, blue light's on. Now I'm on. Okay, just I'll be brief. But like Burgess Chambers was saying, I'm Dwayne Madron, Capital City Trust. The portfolio is overweight cash more than it ever has been. The cash is paying 4.2%, almost the same as a bond. So why take duration risk for 0.2% in bonds? It doesn't make sense. So I'm hiding out in cash, waiting for a correction in equities, which are extremely expensive. The forecast this year for equities is very low. So I'm being very cautious. The last 2 years, equities went up almost 50%. That's rare. So like I said, all the asset classes are in line with policy, and cash is bumping its head on the upper range. And I'm hopeful that we get an opportunity to invest in equities in the near future. If there's a pullback with the new administration and president, there's a lot of new policies coming out that may cause volatility in the market, things like tariffs and energy policies. So we might see an opportunity to buy low, which is what we want to do. So that's all I have to say. Thank you.
Thank you, sir. Any questions for Mr. Madron? Thank you, sir. We need to accept his report.
Make a motion to accept the Capital City report.
A motion by Sugden to accept the report
I second that motion.
and a second by Mr. Romero. All in favor?
Aye.
Up next, Mr. Donlin, Foster and Foster. Good morning, sir.
Morning. So I brought the iPads to the presentation, and it's 436022.
Four, 36022.
Yes.
Thank you.
So hopefully it'll come right up to page 6 of the report. And so the costs went up a little bit, which might be surprising because we had a great return in the fiscal year. But remember, we used that 4-year smoothing technique. And so, and then also, the market did well, and you guys all know that your multiplier fluctuates. And if the market does well, then we can increase that benefit accrual rate. And so in this report, it's going from 3.15 to 3.22. And so, that makes the cost of the benefits higher. So for the investment side of it, we can go to page 32. So if you get there towards the top of the page, it says development of investment gain or loss. And it says at the beginning of the year, we had 9,117,000. And we have a 7.4% assumption. And so we expected to earn about 673,000 on our money. And we actually earned 2,015,000. So we beat our assumption, that 7.4% assumption. We beat it by 1,342,000. So if we were just looking at the 1 year, it was probably the best year you guys have ever had as far as the amount of money that you earned. And so if you, but if you look in the upper left-hand corner, what we do is we take that gain, that $1.34 million gain, and we spread it out over 5 years. So we're going to recognize 268,000 this year and another 268,000 the next year. And so that way the city's costs don't go way up and way down each year. But the state monies, the multiplier, remember, we're not using smoothing for that. So since we had that great return this year, we increased the multiplier. And when we had the bad year in 2022, we reduced the multiplier. So, we're not smoothing for purposes of the benefit accrual rate. And so that's why the costs go up on page 6, because we're increasing the multiplier, but we're spreading out that gain in the funding requirements. So that page is really good news, except that when you average in those 4 years, it's 6.43%, and we have the 7.4% assumption. So we still didn't quite make up for the 2022 loss, but we made a big step towards making up for that 2022 loss with this year. So does anybody have any questions about that smoothing on the assets? So then if you go a few pages later to page 38, so at the beginning of the year, you guys had 22 firefighters, and you had one person terminate, and they were not vested. They just hadn't yet gotten a refund of their contributions. And so you had one person terminate non-vested, and nobody retire, and you hired 4 new firefighters. So you went from 22 to 25, which did help on page 6, because if you have more firefighters, more payroll to spread out your unfunded actuarial accrued liability, that helps. So that reduced the percentage a little bit on page 6. At the bottom of the page, this is when it sucks to be an actuary, because everybody living one more year, was a little bit of a loss for the pension plan, but good for all the retirees.
I appreciate your perspective, Patrick.
Yeah. I don't know if I appreciate it, but so then if you go to page 18, well, that should be the last time we go very far, so. So at the beginning of the year, the unfunded actuarial accrued liability was 2.2 million. But remember, we're making a payment each year to pay that down. So we expected it to go to 2,034,000, and in the end, it was 2,517,000. And so the regular experience of the plan was a loss of 194,000. One thing I didn't mention was that average salary increases were a little lower than the expectation. And so that creates a little bit of a gain, because then everybody's projected benefits at retirement aren't quite as much as we expected the year before. And so investment return was a loss, salary increases was a gain, turnover was a loss, mortality was a loss. So other than the salary increases, nothing really helped the plan, but and then changing that benefit accrual rate, everybody's multiplier goes up retroactively. So the accrued liability goes up for all of the firefighters. So that was an increase of 289,000. So the previous page 17, 16 and 17, that has the $2.5 million unfunded. Well, we're paying 343,000 a year to pay that down. So we're aggressively paying down that unfunded actuarial accrued liability. That's why this year it would have went from 2.2 to 2.0 if we didn't have any other experience. So I just wanted to point that out. And then if you go to page 16, if you guys are all on the board here in 4 more years, you'll be happy, because our oldest bases there, if you look on page 16, have 4 years left. And so once we pay that off, then we won't have that payment anymore. So in about 4 years, the cost should come down a little bit for the city, because we'll have finished paying off those bases. So lastly, or almost lastly, I'll take you to page 13. So this is how we get that funding requirement on page 6. You have a normal cost, which is just everybody accruing benefits each year. So that stays pretty stable from year to year. 19.6 last year, 19.6 this year. And then you have the administrative expenses, our fees and pension resource centers and all that. That went down slightly from 2.9 to 2.8. But it probably went up as a dollar amount, but your payroll went up. So it represents a smaller percentage of payroll now. And then same thing with the third line. That's the mortgage payment, that payment required to amortize the unfunded. That went from 20.4 to 20.8. So you can see if we wouldn't have changed the multiplier, the cost would have actually went down by 2% of payroll. And then the last thing I'll point out is the funded ratio on page 11. You're still in the healthy range. You want to be in the 80 to 100% range. And you went from 82.1 to 81.1% this fiscal year. Well, those were kind of the highlights of the report, but I'd be happy to answer any questions anyone has.
Yeah, I have a question. So we should expect to hear from our retirees. They should get an increase coming when?
10/1/2025. But I do want to get with the city and stuff in between the meetings, because it almost looks to us like the benefits didn't get reduced 10/1/2023. But we'll investigate that. But yes, they're going to increase assuming they decreased before, then they'll increase on 10/1/2025.
Why would, so just a question for clarity, why would they have felt that in their monthly pay?
And then I'm just seeing something wrong. It must have decreased, but I get with the city and see
Clarify.
what we're looking at. But yes, it will go up then 10/1/2025. It was 3.35, right, before, and it went down to 3.15, 10/1/2023, and now it's going to go to 3.22, 10/1/2025. So we, like I said, we didn't quite make up for the 2022 loss with the great year we had this year, but we did improve it. And so we get to go up to 3.22.
That's good news.
And then I also did, you guys wanted me to update the study, so I brought that as well. I couldn't really decide what multiplier to use because now, it went up to 3.22. But I kept it at the 3.25 for the study. So now the costs are a lot less. Last year we were going from 3.15 to 3.25. So now you could go to 3.25 and it would, including the current and the future retirees, and the city's costs would only go up by 0.9% of payroll. And if the members wanted to pay for it, it would be a 1% of payroll increase. So they go from 4% to 5 or
6 to 7.
6 to 7.
So we need one more good year.
Yeah, and I mean, this year we were off to a good start, but now we've had a little setback. It just depends. It could be a volatile year. It could be a great year. It could be a bad year. We don't know until September 30th.
Anybody have any questions for Mr. Donlin?
Do you think it would be better for us to wait to fix it until it's a good year?
Well, that's the thing. I mean, normally I've been rounding to the nearest 0.05, but I'm like, let's do it because that would have been 3.2%. And I'm like, let's go to the 3.22. And in case you're going to fix it now, I don't know, to answer your question. We don't know if the market's going to do well or poorly for the next 3 years. It could do great. It could do terrible. So if you want to eliminate the risk, you could fix it now at the 3.22, or you could wait a little bit longer.
The average over the last 20 years, it's still higher than 3.25. So I thought it's probably better to do nothing. It should go up.
Yeah, I mean, you certainly can do nothing and wait until you have but it's like the market, when you buy low, sell high, you try, but you don't know.
Thank you.
Certainly. Any other questions for Mr. Donlin? Accept the motion to accept his report as read.
I got a motion.
A motion made by Sugden. Have a second.
Second.
A second by Lenedy. All in favor? Thank you, sir. Appreciate your time.
Well, and I'm sorry, but back to your question a minute ago. You know, that's partly why we did the study too. I mean, if you wanted to, I think 3.29 was the longest during that period. So if you wanted to go to 3.29, it would just be a little more than twice what's shown on this study, right? The 3.22 to 3.25. If you wanted to go 3.29, it would be, you know, just a little more than twice what's shown, or yeah, a little more than twice what's shown on this study. And it'll be less than what was shown in the study last year. So anyway, you could negotiate with the city and say, we want to go to 3.29 and then fix it forever. And that way it doesn't fluctuate. So, you know, it's up to you guys how everything
We
happens.
fix it at 3.29, we have good years, that extra money, did that decrease? The
It helps the city. So, you know, there would be, anytime the market does well or poorly, the city's costs on page 6 would go up or down. That's the way it works at all of my other plans. You know, when I went to the other plans this year so far, the city's costs mostly have come down some. Because remember, before we changed the multiplier, this valuation report, the city's costs would have went down some because they had a good year on the investments. So the risk is on the city after that point.
And then just for clarity, when there's an overage, right, you would agree that was where that share plan would come in, right?
Well, the share plan would be state monies,
I got
not
you.
the investment return.
Understood.
The investment return would only affect the city. The state monies, you would, if you know, you would fix the state monies probably at a certain rate, a certain amount in your mutual consent agreement.
Yes, sir.
And then anything above that usually would get split 50-50 between the share plan and the,
And in that case, just to, you would not necessarily have to split that money, right? The city could use that money to fund the pension if we agreed that way,
correct,
or at what percentage it gets split at. Is that
correct.
correct. Thank you, sir.
Yeah, if you wanted to say, we'll go to 3.29 and you can use all the state monies going forward, you know, tell that to the city, that's an option. It's all negotiable.
Thank you, sir.
Thank you.
Any further questions? Good. I think we are on to Miss Anna.
Good morning, everyone. I have nothing new to report on my end, so you know, no news is good news sometimes.
Great. Thank you.
Thank you.
Ms. Kyle?
First piece is a memo about the software type 2 audit. It's a very rigorous audit that our firm goes through. What it does is have an outside firm comes in to verify we do what we say we're doing, we're following the rules we're set for. And then outside firm comes in and audits our materials. They ask for copies of things and documentation to say, yes, this is what was supposed to happen with this person's pension or projection. And we passed it again, 17 years in a row, flying colors. So we're very proud of that. And we took a little certificate in and we could show that we are very proud of our audit. The next piece is that we've come up with a new travel policy. And it's to make it easier and centralize it in our office. Currently, all of the plan administrators receive information from all of their boards, who wants to go to what conference, what's coming up, how do they go, how do they get reimbursed, are they getting a travel advance or a reimbursement? This way we've centralized it, just started it, I've only had one person go through it. It's a central email on the trustee travel procedure in blue, listed conference at resourcecenter.com. If you're interested in attending any of the conferences, you go there, tell them that it was your Palatka Fire and your name and what conference you're interested in going with. If you want any assistance doing this the first time, you and I can do it together. I'm available and we can just send an email and I can copy you on it, or we'll just get it done. So I'm not just putting you to the wolves and saying, try this procedure, but I think it will help expedite things, and that we want to make sure we don't miss anybody, everybody who's interested in, because trustee education is so crucial. You'll learn so much from other trustees, from other plans. You'll learn what other actuaries and investment monitors. Generally, everyone goes, these professionals attend the meeting, so you get to ask them questions. And you're not to talk to each other as much as you're supposed to talk to everyone else, but you'll hear a lot of good information. So if you need me to send out the available conferences again, I will do that. I think that should help everyone. And if you're interested in anything, let me know and we can go through this procedure together. I'll make myself a note to send that. That's what I had there, so.
I had a question about the platform.
Sure.
Is not the platform for travel expenditure, but the platform for the resource center for our members? Is there, is there an access built there that they can go and?
Have access for we don't have access to any payroll information as of yet. The city is still controlling all of that. The statements, I don't have any statements for anyone, so there would be no additional information I could give them other than the quarterly reports when I receive them. Those types of things are going to go up there. It's under construction right now, but it's going to be through our website that they'll be able to see the meeting packets, the different reports, Patrick's report, which will be up there. But having access to their own accounts, we don't have any access to that information.
Is that something that will come online for them, us?
Is it something that can come from the bank, perhaps, when deposits are made? I'm not sure if they have the capability of doing that. It's something that you can request, but as of right now, we don't have access to any of that.
Okay. I guess, Ms. Jones, is that something that we would work through HR to try and help?
Yeah, it was my understanding, and maybe I missed something, that we would have a platform that our employees would be able to go on and see their pension and their payments in real time. That was my understanding from the contract. I will review it again, but I had that understanding. So if it's something missing, something we need to provide, I will look at that again and see where we stand with that. I think I spoke to Kyle one time before about that being under construction because they were excited. The employees,
Portal.
yeah,
Yeah.
we're excited about being able to go in and see, what their real time payment would be if they decided to leave or
Understood.
retire. So I will check into
We
it.
can work that out. I mean, if we could get about 10 years worth of payroll, then we could have a calculator do an estimate, that kind of thing. But as I said, currently we don't have any access to payroll.
Understood. On to the quarterly expenditure report.
For your quarterlies, it's the net position and the unaudited. This is the changes that have come through for the quarter. Payments that we made to the different pensioners, and followed by the warrant. I will give you a brief update on the warrant situation. You had agreed that I could be the single signer for the warrant, and that when everything is paid up to date, I will need an approval to ratify the warrant dated today.
Commissioners. Yeah, we will.
Make a motion to approve the warrant. Dated today.
Motion was made by Sugden to approve the warrant,
I second that motion.
a second by Alex Romero. All in favor?
Aye.
Two trustees.
Yes, ma'am. I'll accept a motion to accept the report from Ms. Kyle.
Make a motion to accept the quarterly expenditure report.
A motion was made by Mr. Sugden,
Second.
a second by Mr. Lindy. All in favor?
Aye.
On to public comment. Is there anybody here for public comment? Seeing none, we'll close public comment. On to other business. The plot discussion.
So I asked her to put this in the agenda and I'm not so sure really what we need to discuss other than, I guess I spoke with Patrick on how to make it available to retirees.
Yeah, I mean, a lot of our plans have a partial lump sum option. So when you retire, you get the normal form is 10 years certain in life. And then you get options. Except I think you guys have 75% continued to the spouse. But anyway, you get options from your normal form, and they're all actuarially equivalent, so that it doesn't hurt the city. So what we can do is say you could get up to like 20% of your benefit as a lump sum. So if you were going to get $3,000 a month, well, let's say $4,000 a month, and you take a or $5,000 a month, take a 20% plop, then you would get $4,000 a month. So you would just get 80% of your monthly benefit as a lifetime benefit, but then you would get a lump sum of, say, $100,000 or whatever the value was.
You're calculating that on the amount of years you expect them to live? Is that-
Exactly. Yep. I mean, we calculate the expected earnings we're going to get and then expected how long they're going to live. And we say the full value of their retirement benefit is $500,000. And if you want 20% of that as a lump sum, then you get $100,000 right away as a lump sum. So it works kind of like the drop, where, you get a smaller monthly benefit, but then you get a lump sum payment. So it's kind of like the drop, except that you don't have to declare to go into it or anything. It's just when you retire.
So you work your 25 or 30 years and then you just drop, you're just out, and then you could make that option as you retire to.
Exactly.
Understood.
But that would have to be done by ordinance.
Is there any negative impact to the pension or?
Actuarially, no. I mean, yeah. I mean, that's the whole idea. Sometimes you're going to win, sometimes you're going to lose, right? Somebody might take the 20% plop and pass away the next year. Well, then they benefited from it. But somebody might take the 20% plop and live to 100. And then the plan comes out ahead because we only paid them 80% of their lifetime monthly benefit for their life. So it's all calculated so that on average, it's neutral. The plan's not going to come out ahead or behind. That there's some people the plan's going to win, some people it's going to lose from. That's the way that all the benefits work. But on average, the plan's not going to get hurt or helped by people choosing this partial lump sum. And we keep it to like 20% because the whole idea of the pension plan is to provide a lifetime benefit that the members can live and rely on. So if we give them a lump sum of 100%, well, then it's not really doing the purpose of the defined benefit pension plan.
Is there a negative impact to the city in that case? in this case. It is cost neutral across the board for everyone. Pension plan, city.
I mean, that's what I would opine. I would write a letter and say, if this is adopted, it will not change any of our funding or anything like that. What did you say?
Can we do it? Is that a motion or is something we have to?
Well, you would probably have Anna draft a proposed ordinance and send it to the city, because the city has to, it's a change to the pension plan. So just like we're talking about fixing the multiplier, that would be a change to the pension plan that has to be done by city ordinance.
Is this also something that lots of other pension plans have? Is this?
Yeah, I mean, I would say about half of my plans have it. Maybe more than that, I'm not sure.
Miss Anna, do you see any problem with that?
I don't, like Patrick said, it will have to go through the ordinance, change requirement with the city.
And then, so in this case, is that something that we would vote on to ask them to do? Is there any further discussion? Let's vote.
Make a motion. Motion to vote to request Anna to make a draft, change the city ordinance to make a plot available.
And do we need to set the parameter to that 20%
I think that's legal, right?
per Patrick's?
I would say that you allow options of 5, 10, 15, and 20%. That's what most of my plans do.
Miss Anna, did you get that?
Yes, 5, 10, 15, and 20% options.
Yes, ma'am. Thank you. A motion was made by Sugden for the plot benefit.
Second.
And a second by Lenity. All in favor? Aye.
Thank you.
Motion passed unanimous.
Patrick, I might email you just to make sure I have all the details on that.
Perfect.
With no other business.
Make motion to adjourn.
Motion by Lenity to adjourn. Second by Sugden. All in favor?
Aye.
Meeting adjourned. Thank you.
Thank you.